Welcome to this premium educational note. Think of this as your professional mentorship session, a global masterclass designed to completely transform Forex trading. We're taking it from what a lot of people treat as a random gamble and turning it into a structured, highly scalable digital business. Because let's be honest, way too many people treat the financial markets like a casino, right? They rely on blind luck, emotion, basically just throwing darts at a board. Well, today, we're stripping all of that away. Whether you're an aspiring startup founder, a freelancer hunting for a brand new digital income stream, or you're just totally ready to build real, lasting independence in today's digital economy, you are absolutely in the right place. So let's build your foundation. Okay, let's dive right into this by asking a really crucial, fundamental question. Before we even think about mastering complicated indicators or obsessing over complex algorithms and advanced strategies, how do massive global financial institutions actually measure risk and reward? The secret here isn't some magical software or hidden Wall Street code. No, it's actually a very fundamental, universal unit of measurement. It's literally the DNA of digital wealth in the currency markets. And understanding it, that is your absolute first step to thinking exactly like an institution. To get there, we're going to walk through this exact architecture in this note. We'll decode the language of the market, uncover the math behind the money, install the 50 pip daily system, master market volatility, and finally, wire your psychology for consistent profit. Let's get right to it. Starting with Section 1, the language of the market. To build a towering skyscraper, you first have to deeply understand the strength of the steel and the concrete. And to build a robust, scalable digital trading business, we have to start macro, by zooming all the way into the microscopic building blocks of the market itself. So the absolutely crucial concept here is the pip. Mastering the pip, which stands for percentage and point, by the way, is the exact moment you transition from an amateur playing a guessing game to a true professional running a digital operation. It is the universal language spoken by everyday retail traders and massive global investment banks alike. It's simply how we measure every single movement. You've got to stop thinking in dollars and really start thinking in pips, probabilities, and risk. Now let's look at how you actually read this mathematically. While most major global currencies, like the euro or the US dollar, measure a pip way out at the fourth decimal place, so a tiny move from 1.1050 to 1.1051 is exactly 1 pip, the Japanese yen is the notable exception. Because of the yen's historical value structure, its pip sits at the second decimal place. And to give you even more control, modern brokers have added an even smaller decimal called a pipette. It's basically a fraction of a pip, giving you unbelievable pinpoint accuracy for your business. Moving into Section 2, math behind the money. Because, look, knowing the value of a single pip is completely useless if you don't know exactly how to protect it. That brings us to the operational costs of your new business, where we connect the abstract concept of a pip to your actual hard-earned capital. This perfectly illustrates your inventory management. Think of yourself as an inventory manager. In Forex, we buy and sell in standard batches called lots. Leveraging a standard lot means every single pip movement equals $10. So if the market moves 10 pips, that's $100, made or lost. That's some significant leverage. But notice that micro lot at the bottom? A micro lot scales that financial exposure all the way down to just 10 cents per pip. This is incredible because it gives you total granular control over your inventory. You can tailor your financial exposure exactly to the size of your account, whether you're starting with $100 or $100,000. Now imagine you're a startup founder fiercely protecting your financial runway. Your absolute unbreakable rule is to never, ever risk more than 2% of your total equity on a single trade, period. If you've got a $1,000 account, your maximum risk per trade is exactly $20, not 25, not 30, 20. You calculate your protective stop loss in pips, match it to the exact right lot size from our inventory table, and suddenly, you're operating with the cold, calculated precision of an actuary instead of the wild hope of a gambler. And how do we actually secure that strict 2% risk? We do it by logically placing our stop loss orders just behind structural swing highs and lows in the market. We aren't just picking arbitrary numbers here. When the main trend is pointing down and you're actively selling, your protective stop loss goes safely just above those recent peaks. And conversely, if you're buying in an uptrend, it goes safely below the recent valleys. You're strategically putting your protective shield exactly where the market will have a really hard time reaching. Basically, you're forcing the market to prove you completely wrong before you exit. Which brings us to Section 3, the 50 pip daily system. Now that we have our solid business insurance and risk metrics firmly in place, let's install a highly practical visual workflow to actually go out and generate digital income. The 50 pips a day strategy is this incredibly actionable 3-step system. It completely removes all of that confusing indicator clutter you constantly see online and focuses purely on price action momentum. We're stripping away the noise entirely. We'll trade like seasoned professionals using just 3 core components: the 200-period exponential moving average for our trend, simple diagonal support and resistance lines, and lastly, the language of the candlesticks themselves. Let's break down how this builds visually. First, we look at a 4-hour chart. This brilliantly filters out all that frantic minute-by-minute daily noise. That moving average line flowing across the screen, that's our compass. If price is trading cleanly above that upward sloping line, we are exclusively looking for buying opportunities. We're trading with the heavy momentum of the market, not against it. It's exactly like swimming with the current. And naturally, if price is below a downward sloping line, we strictly only sell. Next up, we wait. We wait for the price to temporarily retrace or pull back against that main 4-hour trend. Then, we draw simple diagonal support and resistance lines connecting those specific swing points. By connecting 2, 3, or even 4 distinct points, we are essentially trapping the pullback. We're boxing the price in, waiting patiently to see exactly when the dominant market force will step back in, break that line, and resume the primary trend. And finally, step 3. We wait for a massive confirmation candlestick right at that breakout zone, proving without a shadow of a doubt that the large institutions have stepped back in. We don't guess, we don't anticipate, we wait for the market to undeniably show its hand. We're looking for a large candle closing near its absolute low for a sell order or its absolute high for a buy order. That visual footprint is our ultimate green light to confidently enter the trade and deploy our capital. Moving on to Section 4, Mastering Market Volatility. To truly future-proof this daily system and ensure our new trading startup actually survives constantly changing global environments, we really need to mathematically understand the speed of the market we're trading. Because, let's face it, not all currency pairs move at the exact same pace. By diligently tracking the average daily range, or ADR, and the average true range, the ATR, you can set highly realistic, data-driven profit targets. No more blindly relying on pure hope. Let's break that down for a second. If a specific currency pair historically only moves 60 pips a day on average, setting a massive profit target of 150 pips for a single day trade is just terrible business logic. It's fundamentally broken math. You've got to align your financial expectations with the mathematical reality of the asset you're trading. Otherwise, you're just hoping, not operating a true digital business. This is exactly why professional traders use dynamic tools like the 2x ATR strategy. They deliberately place their defensive stops 2 times the current ATR value away from their actual entry price. Why do they do this? Because it allows the trade to breathe naturally. You won't get accidentally stopped out by random market noise or sudden unpredictable volatility spikes. You are effectively giving your trade a mathematical buffer zone based on the real-time heartbeat and volatility of the market right at that exact moment. Let's look at Section 5, the psychology of profit. With the physical mechanics, the deep math, and the visual system completely installed, your ultimate long-term success relies entirely on your mindset as the key operator. You can honestly have the best business architecture in the entire world, but if the CEO makes rapid, emotional decisions, the business fails. The difference between a reckless gambler and a calculated business owner is incredibly stark. Even with a meager 33% win rate, meaning you literally lose twice as often as you win out there in the markets, a disciplined business owner targeting a 1-to-3 risk-reward ratio will remain highly profitable over time. Really think about that math for a second. Let it sink in. You can be wrong in the vast majority of the time and still make excellent money. Why? Because your winning trades are mathematically engineered to be 3 times larger than your strictly controlled 2% losses. Meanwhile, the emotional gambler completely destroys their entire account through revenge trading, cutting their small profits early out of sheer panic and desperately holding on to massive losing trades out of stubborn, unfounded hope. You have to be the business owner. Let the math do the heavy lifting for you. Finally, Section 6, your digital trading business. Let's quickly recap the ultimate blueprint for thriving in this modern digital economy. By aggressively treating your trading as a highly structured, scalable business rather than a weekend hobby, you are opening the literal door to true geographical and financial independence. The absolute key takeaway from this entire mentorship session is that every single profitable trade, every strategy, and every risk decision traces directly back to mastering these specific, unbreakable rules. Treat this as your daily operational checklist. You must think in pips, not dollars. You must calculate the precise monetary value of your inventory before every trade. You must brutally and logically limit your risks to exactly 2%. You must always wait for crystal clear visual price action confirmation. And finally, you have to let hard data and tools like the ATR strictly govern your exits rather than human emotion. The universal language of the financial markets is officially waiting for you to boldly speak it. The mechanics are proven, the daily math is absolute, and the entire digital economy is wide open for those willing to learn the ropes. So the only real question left for you is, what will you build with it today? I deeply hope you found this global masterclass note incredibly valuable for your journey. Now get out there, meticulously manage your risk, and start building your future.